All right, let's dive into Charlotte's Web's latest earnings call. This is a really interesting one because the company is right in the middle of a big turnaround attempt. And this quarter, well, it gives us a fantastic look at whether that story is actually playing out. So let's just get straight to the numbers. So right out of the gate, you've got this classic good news, bad news situation. It's a real tug of war. On one side, they actually beat what analysts were expecting for revenue, which is great to see. That's 2 quarters of growth in a row. But, and it's a big but, they missed on the bottom line, on earnings per share. And that right there, that's the puzzle Wall Street is trying to solve right now. So let's break it down. Okay, section 1, the numbers. Let's take a quick look at the headline figures that really got the market talking. So the big headline here on the positive side, revenue. They pulled in $12.8 million. Now, that's up more than 4% from last year, which is solid. But here's the really important part. This is the second quarter in a row they've posted growth. That tells you, hey, maybe, just maybe, they've stopped the bleeding and are actually starting to turn this ship around. But, like I said, there's always the other side of the story. And here it is, a loss of 4 cents per share. Now, Wall Street was only expecting a 3-cent loss, so that's a miss. It just goes to show you, even with revenue ticking up, getting back into the black, well, that's still a ways off. Now, this next number is absolutely crucial if you're bullish on this company. Check this out. They cut their SG&A, that's their day-to-day operating costs, by almost 32% compared to last year. That is a huge drop. It shows management is dead serious about getting lean and mean. This isn't just talk. They're actually tightening the belt in a big way. So here it is, all laid out. You can see it clear as day. A beat on revenue, a miss on EPS. But look at that adjusted EBITDA line. That's a key metric for how the core business is doing, and it's improving. So what does this tell us? The cost cutting was working, the revenue is growing. But yeah, they're still burning through cash to get there. It's the perfect snapshot of a company in transition. Okay, so given that mixed bag of numbers, the big question is, what's the plan? What's management actually doing about it? Well, they laid out a really clear strategy on the call. Let's get into it. Discipline and innovation. And the plan itself is pretty simple, which I actually like. It's a 2-pronged attack. Step 1, radical cost discipline. Basically, trim all the fat and stop burning so much cash. Step 2, innovate and expand. This means creating new, exciting products and pushing beyond just CBD into this bigger idea of botanical wellness. It's defense and offense, all at once. And this isn't just fluff. They put some real numbers behind it. We already saw that huge SG&A cut. But then there's this. They're bringing gummy production in-house. Why does that matter? Well, it means they don't have to pay some other company to do it, and they think that'll save them around $3 million a year. You add that to everything else they're doing, and they're aiming to slash about $9 million from their annual costs by 2026. And the endgame for all of this? Get close to being cash flow positive in 2026. That's the target. So what about that innovation piece? Is it working? Well, listen to this quote from the CEO, Bill Marchnick, about their new Brightside gummies. He said they exceeded our projections with initial SKUs selling out during Memorial Day weekend. I mean, come on, selling out? That's exactly what you want to hear. It's an early sign for sure, but it tells you they might have a real hit on their hands in a super popular part of the market. And look, they're not putting all their eggs in one basket. They're branching out into other things like CBG gummies and even functional mushrooms. Stuff you can sell on Walmart.com or Amazon without all the regulatory headaches. But then they have this really interesting long-term bet. It's this joint venture called DeFloria. They have a drug candidate that's now in a phase 2 trial with the FDA. Think of this as their high-risk, high-reward moonshot. If that pays off, it could be a complete game changer down the road. Okay, so that's the company's internal story. But as we all know, especially in this industry, you can't ignore the outside world. So let's zoom out and talk about the bigger picture, because things are, well, they're messy. And that brings us to the million-dollar question for this entire space. Is all this regulatory chaos a bad thing for everyone? A major headwind? Or is it secretly a good thing for a bigger, more established player like Charlotte's Web? Could it actually be a moat that keeps the smaller guys out? Honestly, the answer is probably yes to both. I mean, just look at all the moving parts. You've got federal rescheduling talks that have completely stalled out. You have Congress arguing over what to do about products like Delta 8. And the FDA, well, the FDA is just doing its own thing, enforcing rules here and there. Now, management's argument is that all this chaos actually helps them in the long run by knocking out the competition. But right now, it's just a giant dark cloud hanging over the whole sector. All right, let's bring it all home. We've got the mixed numbers, we've got the turnaround plan, and we've got the regulatory mess. So, what's our take? Let's talk about our rating and a pretty interesting trade idea. We're calling this one a market perform. So what does that mean? Basically, we expect the stock to perform about in line with the rest of the market or its peers. Why? Because you have this perfect balance. On the one hand, you have to give them credit. The cost cutting is real, the innovation is starting to show promise. But on the other hand, real profitability is still a ways out, maybe 2026. And that regulatory cloud we talked about isn't going away anytime soon. It's a classic case of progress versus risk. But if you're looking for something a bit more interesting, we've got a trade idea for you. Now, let's be clear, this is a speculative play. It's the kind of thing you might see a hedge fund put on to bet on one very specific outcome, while trying to block out all the other noise. So here's how it works. It's a paired trade. On the long side, you'd buy some call options on Charlotte's Web, but ones that don't expire for a while. This is your bet on the company. Specifically, you're betting on that DeFloria clinical trial, that moonshot we mentioned. You're hoping for great news there. Now, to protect yourself, on the short side, you'd short the MJ Cannabis ETF. That's a bet against the whole sector. The idea here is to hedge out all that market-wide regulatory risk. So if some bad news hits the whole industry, your short position helps offset losses. It's a way to try and isolate your bet purely on that one specific clinical trial. It's a scalpel, not a sledgehammer. And of course, we have to say it, this is not financial advice.